I am going to talk about a little bit about fear, because fear is a pretty important part of our trading. And this is a quote that I really like. Danger is real, fear is not. Avoid danger, confront fear. I really like that. It really appeals to me, and I look at this every day, and it's super true, because everyone thinks that fear, oh wow, I fear this, so it must be dangerous. Not necessarily. I fear crocodiles. That is a real fear, but I don't fear crossing the street. There is potential fear, but if you do things properly, then there's no danger associated with that fear. It's false fear. If you do things right, and so it's a very interesting relationship between danger and fear. So I think if you keep focus on that, on the fact that fear is not real, then I think that you're focusing on something correct. And so I'm going to talk about 4 trading fears and how they affect our trading. Also going to show off the new Pipnotic logo. Anyway, so the agenda is we're going to look at the 4 fears. We're going to discuss about dealing with these 4 fears. I'm going to talk a little about some exercises that I use for dealing with fear. And fear is an issue that I deal with. I wouldn't say that I deal with fear so much anymore, but I get those feelings when I enter a trade. You know, oh, the trade goes against me. I can feel it, and I register it, and it's like it's uncomfortable. And so you have to, as long as it's uncomfortable, then you have to work with it. I'm not a Warren Buffett and so I feel I'm a little bit more perhaps sensitive to the way price moves. And so it's important, I think, that you have specific exercises. And while the exercise that I'm going to share with you aren't necessarily the only way you can do it, they seem to work for me. And so I think that maybe you could give them a shot if you think that would be interesting. Okay, so the 4 fears and the primary fears, and I made on my website, I like to put out polls every so often. So I'll have a I'll wonder about something. I wonder what kind of fear the people suffer or trouble with the most. And so I make a poll, I put it on my website, I'll let it sit there for a month or 2, and then I'll have like a lot of insight into the visitors of my website. So these could be also people from anywhere. And the results of this poll gave me this here. So the primary fears were, number 1, we had the fear of losing, which of course is a huge fear when we trade. And you feel this fear all the time when you're in trades, before you get into trades. So it's always there, it's constantly there. Then you have the fear of missing out. So if price comes up to your entry, it comes within your entry to a pip, and then it goes the other way, and you think like, oh, I should have been on that boat, you know, and you feel really gutted. And so this is also a very real fear. Then you have the fear of letting a winner turn into a loser, and you have this all the time. And this is typically associated with, you get into a nice trade, price moves in your favor, 20, 30, 400 pips, and then it starts to retrace, and you think like, oh no, the trade is going against me. I had 400 pips in the bag, and now I only have 100. What should I do? What should I do? And this is a fear, and you have to be conscious of this fear in order to be able to deal with it. Then you have the fear of not being right, and the fear of not being right is based on ego. And ego and pride are not the same thing, and so ego is pretty detrimental to your trading. It's a very masculine energy, ego, and so it should be something that should be avoided. And you can be aware of the ego by the way it feels. By the way you feel when you think about something. Ego will typically there's typically associated like a hot energy, so anger. So if you're feeling angry, then it's typically the ego. Or if you feel perhaps more vulnerable, then it's more pride that's being challenged. Okay, so the fear of losing. I mean, how do you see this? How do you experience this in your trading? Well, typically there'll be a tendency to perform too much of an analysis, and this you see with a lot of beginners who have a ton of indicators plastered to their charts. They are looking for so much confirmation that they are making the right decision, and they won't do anything until everything says buy, 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 buy. So they're looking for all these lagging indicators to line up buy, 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 and they won't do anything until everything tells them to do. So they simply overanalyze the situation. And the funny thing is that in trading or any other market, you are constantly being forced to make decisions to do something or not to do something in an environment that is completely, well, relatively unpredictable. I'm not going to say completely, because we expect price to react at certain levels, and so we don't predict it, but we expect it to a certain degree. And so you are forced to make decisions in an environment that can do anything at any time, and it does provoke fear, and sometimes a lot of fear. But if you're aware, if you acknowledge this fear, then you can address it and learn to work with it. If you deny that the fear exists, then it's a different story altogether. So typically you won't pull the trigger because you want confirmation that what you're doing is indeed the right thing to do. So it's going to keep you out of trades. It's going to keep you, it's going to force you to get out of trades prematurely. And this is a bummer. There's nothing worse than getting into a trade, exiting after a short movement, and then watching price continue in the direction of your trade, and typically once you've exited all the way to your target, which is typically where it'll turn around. So that's a bit of a bummer, of course. And also, this is also pretty much related to the result of trading. So the trade, did I win or did I lose, more than the process of putting on a trade. So performing your analysis and putting on a trade. And so the focus here is on the wrong thing altogether. And perfectionists often suffer from this, because everything has to be just right. I have a friend who trades, and this guy has super intelligent, a huge perfectionist, and so everything has to be right for this guy to take a trade. And he never trades. He never gets any trades on. And whenever I speak with him, I think I mentioned this maybe half a year ago, he's telling about the new thing, the new research project that he's working on that's going to help him confirm when trades are mature and ripe for picking. I kind of shake my head and think man, you don't have to be right, you just have to do it. So I mean, the fear of losing is definitely something very, very big. Then here we have, the fear of missing out. And this is a bummer. We see this all the time. Every week we have people send in trades. Oh, price came within 1 or 2 pips of my entry, and then it dumped, and I didn't get it. And that's a bummer, but that's just how it goes. And so the problem with this is, if you don't want to miss out on a trade, you're at risk, because then you will force yourself to get in the trade at any price. So if price comes up to your level, minus 1 pip or plus 1 pip, and it moves, and then price starts to move away, and now you're convinced that price is going to move, then you just click in at market, and then you have, then you're exposed. You have more exposure to the market. So you got in at a much worse price. Your stop is, you might have to move your stop closer so you can use the same position size. So your stop is now threatened, and so it screws everything up. And often this is going to be driven by greed. And you can feel what greed is like. Again, it has like a funny energy, and it's located in a certain place in the body, in the stomach, and you can feel it. And if you learn to kind of feel or differentiate between these different emotions, greed is one that is very unique. So when you have these feelings of greed, then you should certainly be aware of that. And again, if just clicking into trades because price got quote unquote close enough to your entry, then this is perhaps an emotion or a feeling that you're quite familiar with. And typically you'll feel it where you'll think oh man, I can't believe I missed out on that trade, and you'll be like, damn it, and you'll be angry or whatever. And again, greed it's a very masculine emotion or feeling, and so it's often going to be there's often going to be a lot of temper or anger attached to it. Yeah. And often here, this is another one, when you get in, you often think that price is going to keep on going. Sometimes it does, sometimes it doesn't. But had you got in at the original entry, when price reached the place where you had to got in, you could have reduced the risk. But now you can't, because your stop is perhaps, or your entry is at a place where you can't move your stop, so you can't you simply can't move your stop to where your entry is, because then your stop is exposed. And so, I mean, everything goes wrong when you're faced with this kind of a situation here. Okay. Then we have this one, the fear of letting a winner turn into a loser. Yeah, I mean, this is actually, I did a poll maybe 5 months ago, where I asked, what is the main thing that you struggle the most with? And people, I think over 70% of the people said taking profits too early. And there was 180 people that filled out the poll. So 70% said that they were taking profits too early. And that is a huge bummer, because if you think of the total traders, who I'm pretty fascinated by, I mean, these guys were winning 30% of the time. And so they absolutely, positively were not allowed to take profits too early. You can reduce the risk, but you cannot take the profit too early. And this is, of course, because you have sweet 100 pips in the bag, and you're thinking, oh, this is great, and then price starts to retrace. And price has to retrace. Price just doesn't go straight up and straight down. It's in the market, it's a living, breathing beast, and if price has to go higher, it has first to move lower to fill orders. They're going to push price higher. So it's simple. It's a natural rhythm of the market to move up and down on its way, either higher or lower. And so you have to let it do that. And so this is very, very typical. And today I did one of the exercises that I'm going to do, because I didn't do a lot of trading this week, but today I had time for an exercise and I did it. And it's just fascinating to see what's going on. And I had the feeling here of letting a winner turn into a loser. I got into the trade, then price moved in my direction, so I had like a few pips. It was a 1 minute chart, so I can do these exercises quite often. And price has moved in, it's like up 2, 3, 4, 5 pips. Then it started to retrace. And then you can just feel that feeling. You can feel that tenseness in your stomach, and it's really exciting and very interesting to be able to put yourself in the lab and experiment with these different fears. And so while I really wanted to take the trade off the table, emotionally I didn't do it, because logically, I mean, that's not where my target was. So I left it. And so you kind of have to stick to your plan. Yes, and this fear often rather forces you to maybe move your stops too close to where price actually is. So prices are bumped out prematurely, which of course is a bit of a blow, which is the same thing as just taking the trade off. And here it completely breaks down the probabilistic trading model. So if you're, like they say, cut your losses and let your winners run, if that's the way you want to trade, then you have to let these trades mature so that they can reach your target. And typically you can see this on account very, very quickly. And you'll notice that there'll be a lot of small wins and there'll be a few big losses. So ultimately, the account will be break even. So you'll have maybe 10 winners, 15 winners, then you have a loss, and the loss will gobble up maybe 5 to 10 of the wins. Then you have another string of wins, and then there'll be another big loss, and that'll gobble up a bunch of the winners. And so it's very easy to see if you're micromanaging or fiddling or taking profits prematurely. Yeah, so this is a very interesting one as well. And here we have the fear of not being right. And this is, again, I mean, all about the ego. And the ego is the devil in disguise. I think, like I said, it's not the same as pride. You can be proud about something, but pride is a softer energy, and ego is a harder, more aggressive, more masculine energy. And so you can differentiate between the two. And the thing is here, I mean, I've been trying to look to sell the dollar yen this week. So I had one trade on this week, and I lost. I got stopped out, and I had in my mind, wow, price is inefficient. Price is inefficient. It's moved up. We've moved into supply. I want to sell it, and I could have been a big ego thickhead and just kept trying to sell it, or I can kind of look at price, look at the very, very obvious, the dollar is going to go up, and then I can become a buyer and turn everything around and say, okay, I'm going to start buying. So I took my loss, I took my ego, I chucked it out the window and watched it splash on the street. And then you change your plan, and then you look at the market via fresh eyes. And if you're not doing this, then it will prevent you from looking rather not looking at, but seeing the obvious. So you'll be looking at the price of a chart that's moving higher, and it's approaching an area of supply, and you think, this is supply, price is going to go down. And so you keep trying to sell it. You take a loss, instead of saying like, okay, no, this area of supply isn't going to hold. Wait for it to break, or wait for confirmation, wait to see a trend line break, and then get in. But don't be a pighead and continue to fight the market, because everyone will always lose. And so here you accept, you refuse to accept being wrong, and then you end up just taking big losses. And in here, I don't think that there's a problem of that, but maybe in other trading rooms or other trading environments, maybe people don't put in stops, or they move their stops, but it's not my impression that people do that a lot here. People are pretty disciplined here with respect to putting their stops in and leaving them. And you don't move them thinking, oh, price is going to keep going, oh, I'll let it come down a little bit further, because when it gets down to here, then it's going to go up. And then price comes down to there, oh, I'm going to move down a little bit further, because when it comes down to this one, because this is actually an older sibling or a parent, when it comes down here, then it's going to turn around. No, don't do that. Accept the fact that you're wrong, take the loss, and move on. So here we have, we'll keep buying, selling in a bear bull market. So the dollar yen is a bull market. I knew that it was a bull market before I got in, but I saw this nice area of supply, so I sold. I took a loss. Am I going to cry about it? No, it sucked, but it doesn't matter. You have to keep going. And so I accepted the fact that price is going to go higher. So now I'm going to wait for some areas of supply to be consumed, then I'm going to start buying, and I have a plan on that. So you have to be able to kind of turn your viewpoint of the market around from 1 minute to the next. Yeah, so it's tough. It can be. I think this one can be tough, especially for like super like egocentric, like big strong alpha men. Like really like kind of chest beating vibe. It's like it can be tough, very, very tough. So I mean, how do you deal with fear? Well, the main thing to deal with, a really good way to deal with fear is to not give your fear confirmation. And how do you confirm what is dangerous in currency trading? I mean, losing money is not dangerous in currency trading. It's kind of a byproduct of trading. But losing a lot of money, that's dangerous. That's what I'll consider to be dangerous. But losing small amounts, that's kind of the nature of trading. You lose small amounts all the time. It always happens. So you have to prevent yourself from suffering from a big loss. And you should never you should never lose more money on one trade than you specify before you enter the trade. So you risk like 0.5% or 0.25% or whatever, 1%. You never lose more than that, because if you do, it's a killer, because psychologically it's gonna take the wind out of you, and then you're gonna lose confidence, and then the fear is gonna grow, and it's just gonna grow, and it's gonna eat you up, and then you won't be taking the good trades when they're there, and then everything falls to pieces. So you have to stick to that. Is probably the number one thing in my optic, is never expose yourself to any one big loss. And the cool thing, I mean, when I trade, I normally risk 0.15 to 0.25% on one of the accounts that I trade, and I know that that's fine. So if I take a loss, then I lose like, I don't know, a couple €100, and I think, oh, that sucks, but I'm not going to cry about it. It's okay. It's fine. I can stomach that. But if I was risking like 4%, I mean, like, that's very different. That's very, very different. And if I lost 4% of my account, I mean, I think I would be in a terrible state, and I wouldn't be able to make clear decisions, and it just destroys everything. So you have to ensure that you do not take big losses. They are an absolute killer. Okay, and then we have this one here, and this is, I mean, we have these rules that we follow. Darko has these rules, and he's super disciplined, and I absolutely love it. I chat with Darko during the day. We're in the same time zone, and we chat a lot, and he's like, man, there's nothing today. There's no trades today. I was like, oh, good. And then the next day, there's nothing today, or a week later, there's nothing. So he hasn't done it for like a week or 2 weeks. I think to myself, like, that's so awesome. He hasn't taken a trade, and it's been like 2 weeks. but he doesn't do it. And he says, oh, I'm just going to go for a picnic with my dog, or I'm going to do something else, and he goes away. So he leaves the computer, and that's super cool. And it requires that you are super strict with your rules, because you have them, they're there for a reason, and you follow your rules. But when you get into a trade, okay, I got into the trade, I followed my rules, this is a high probability trade, it's probably going to work out, and so you expect that. So you get in the trade, and now you have your target that is, let's say, 4 times further away from your entry as your target, as your stop. So you say, okay, I want a 4-to-1 in this trade. Are you going to hold on to that conviction even though something happens and price starts to turn around when you're only like 2 times the size of your stop into the trade? No, you're not. You're going to be aware of that, and you're going to adjust your trade management accordingly. So if some news comes out of somewhere and it affects price and it goes against your trade, then it's a really good idea. Open the window, tear your ego out of your chest, throw it on the street, and then look at the situation, look at the chart, and say, okay, actually price no longer supports the premise for this trade. What am I going to do? Then you have to make a plan. And this stuff should be planned before you get into the trade. So you say, okay, I don't want to close the trade prematurely, so I'm going to reduce the risk so I have no exposure to this trade. That is the best thing to do. And I remember Darko and I, we were trading one day, and we were chit-chatting, and we were actually in the same trade. And Darko said, I said, oh, the market's changing. We're talking about it. And the market started to change. And Darko said, I can't take it off. I can't take some of the trade off. And I like that. I can't take some of the trade off. And while, of course, you can, but Darko has these rules. He's like, no, man, I can't do that. It breaks the model. He said, I have to stick to this. And it says that I can't start scaling out because according to my trading model, that's not how I do things. And so he stuck to it. I can't remember what happened, but he stuck to his plan, and I think that was marvelous. Yeah, so that's that one. And then again here, the one at the bottom is you have to focus on the process. The process is actually quite fun. I mean, looking for the trades, marking them off, maybe using the software to draw these lines, and everything looks really nice. That should be the fun bit. Getting in the trade is maybe. Should be perhaps maybe even boring. So you get filled and you just let it do what it does. You keep an eye on it. You maybe you trail the stop according to opposing areas of supply and demand on the smaller time frame. Then you let it go. But constantly focusing on how much you're going to win or how much you're going to lose is completely the wrong mindset. You have to be focused on the here and the now. So now you're in the trade. Okay, what's going on? I'm in this trade. I got in at this area. It was a good area. I'm convinced that the trade has a higher probability of working out than not. And then you manage the trade and you leave it at that. And you don't focus on, oh shit, if price does get to my target, I'm going to win $100, yes, and then you start thinking like, oh, you get that feeling in your stomach. You think, wow, $100, that feels pretty good in your stomach. Or if you consider the loss, you're a bit like, oh wow, minus $50. That doesn't feel good at all. And so you're focusing on the wrong part of the trade. You should be in the now, in the moment, focusing on the process of being in the trade, not on what may or may not happen as a result of your stop or your target being hit. And so focusing on the process occupies your mind enough to keep you away from thinking about fear. Because again, fear is not real. Okay, so dealing with fear, I mean, how do you deal with fear? Well, it's a really difficult thing to deal with. First of all, you have to acknowledge the fact that fear in trading is not real if you're not risking silly amounts per trade. If you're risking 1% or 0.25%, and that's okay with you, then there's no fear. There should be no fear associated with you taking a stop or 3 stops or 5 stops in a row. That's just the way it goes. What you can do is you can journal your emotions. I don't journal my emotions, but I do exercises, which I'll show on the next slide, that help me stay in tune with my emotions. And this is important because you have to be able to identify the different kinds of emotions. Because of the exercises, I have a pretty good idea of what greed feels like for me. I know what fear feels like, where I don't want a winning trade to lose. I know I have a pretty good idea how that feels for me. I know where in my body that feeling is. And I know how a lot of the other negative emotions, fear-related emotions that I fear in the spectrum of being in a trade, like the emotions of being in a trade, because of the exercise I'm going to talk about. And so what you can do is you can have like specific rules that you do, and you can punish yourself for breaking these rules. And when I say punish, I mean I did a talk a while ago about neuro associations, and it's how you associate something unpleasant with making a mistake. And so what you could do is, do you remember when we were all kids and we used to be in the classroom and you got caught, I don't know, chewing gum in class, or throwing a piece of paper, or speaking or something, and the teacher said, "I'm sorry, I'd like you to stay after class. I want you to write 200 times on the board, you can't chew chewing gum in class." And so you'd stand there, "Can't chew chewing gum in the class," and you'd write it on the board. And it sounds really silly, but maybe it's, I mean, I'm not suggesting you do this, but maybe it's something you could consider. So you have a whiteboard or a piece of paper. You don't have to do 200 times, but you have like one A4 sheet, and you have the rule. You kind of boil it down to a short statement. You put on a piece of music that you really don't like, be it Celine Dion or Norwegian death metal, and you put it on your headphones, and you play it at a level that's pretty not damaging for your ears, but potentially uncomfortable or just a little bit unpleasant. Then you can write the mistake that you made on the piece of paper while listening to this music. So you write it down, and you think like, okay, I will not risk more than 1% per trade while you're listening to Celine Dion or whatever it is that drives you mad. The reason I say Celine Dion is because when I used to play football when I was studying at college, and every time we lost a game, the coach used to play Celine Dion for us in the showers. So I have a kind of a negative emotion related to Celine Dion. Sorry, Vic, she's a Canadian native. I know.
That's our good Canadian girl. Well, then, yeah.
So you can find a way to punish yourself. Dave Deming, he donates some money to Jude's Children's Hospital. I don't think that's negative enough. It's actually not negative at all, because he probably gets enormous pleasure out of giving money to these children. That's probably not something that I would recommend. But you can do something like the music, or do something else. If you smoke cigarettes, maybe smoke a kind of cigarette that you really hate or something. I don't know. Yeah, so you can associate something unpleasant with the bad decision, is what I'm trying to get at. Okay, so I mean, the exercises, how do you deal with this stuff? Well, I have something that I call the emotional roller coaster exercise, and I do this on a demo account. And it's really interesting, and I did one today, and I'm just going to show that trade. So I'm on the 1 minute chart, because when I do these, I don't want to have to wait half an hour. I want to do an exercise now. And so I saw this, I marked the area off. Excuse me, we had like a 5 minute area of supply up here. I'm not paying too much attention to the big time frame, so I was in like the 50 minute, the 5 minute, and the 1 minute. And here I said, okay, we have this, let me find it, have this 1 minute area of supply here. Price tested the edge there once, twice, so we were reacting off this. So price was likely going to continue moving low. We had a trend line break as well. We'd already tested this area of supply that broke the trend line. Now we're drifting lower. So price is imbalanced, it's balanced, imbalanced. We have a parent, nice, price managed to move away. So I was expecting price to react at this area. And so I sold here on the 1 minute chart. I put my stop just above here. And I watch it. I force myself to watch it, which goes against what we normally do. We normally say, like, put on the trade in the 4 hour time frame, and then maybe don't look at the charts too much, because then you'll feel inclined to fiddle. And so I put the chart on, trade on. It was tiny. What was it? Let's have a look. It's 0.8, so 8 microlots. So not really, just a small trade. And I put it on, and I watch price go up. You know, and price goes up there. I think zoom in, because I want to walk you through the emotional bit. It went up there, and it touched the level, and it stopped. And I thought, like, yes, it stopped. I was right. What is that? The fear of being wrong. So I registered that. Okay, the fear of being wrong just kind of showed its ugly face, because it felt good that I was right. So it stopped there. The candle closed, and I was a bit like, oh, cool, price is going to go down. Price went up. it went down, and I was feeling really good. I was feeling very clever. And price went up and went above, and I thought like, uh-oh, and then price went up, and then it went up, and it almost went to my stop. I was really paying attention to that, and then I was, okay, what's this? This is the fear of losing, so I was pretty close to losing this trade. And it didn't feel very good. And I was, but I was not caring about that if I was going to lose or if I was going to win. I was focusing on the process of being in this trade and identifying with the different emotions that I feel in my body when I'm experiencing pain or pleasure. Pleasure being I'm earning money. And so price went up, it went down. So we respected it. We had an area of accumulation, a green candle. At this point, I was feeling pretty good. And then price was kind of sticking to this level here. And I was thinking, okay, we didn't have any closes above the area. And then this one came up here. And then it closed just on the area. And then this price poked above. And I was a bit like, I had that feeling again, fear of being wrong. Sorry, the fear of losing. And then we got this one, just like a nice full-body candle. It went down, then it cut down, then it started to break down. And when price started to come down here, I thought to myself, okay, I'm in the clear. So I'm getting close to where I want to get out, and I wanted to get out here because this was an area of demand that took out this supply here, and this is supply because let's just mark that off quickly. See how price kind of touched the area. Actually, we could probably draw the whole area there, the whole candle. We touched it once, twice, 3 times. It cut through it, so this is a pretty good area. So this is where I wanted to be out of this trade. And so I waited till price got to it, and I was thinking, okay, and I was kind of hoping, I was thinking, okay, I was getting unrealistic. I was maybe detaching myself. This is the ego speaking. I was detaching myself with the fact that price was reaching demand. So I was feeling cocky. I was losing touch with, my rules are very strict, but my expectations, I have to be flexible. And so I wanted to get out here, but when price got down here, I was feeling pretty confident. And I said, well, maybe price is going to go down to this one here, or maybe down here. I saw this and I like this. Maybe price is going to go down here. But you have to be aware of that. You have to, instead of getting too tied up with if the trade is going to win or lose, you have to, sorry, there's like people laying in the middle of the street in front of my home. That's kind of strange. You have to constantly focus on how you're feeling about the trade and not focus too much on the trade itself. And so when price is coming up here, you kind of feel a bit pathetic. You feel a bit sorry for yourself. Oh, and you feel you're getting close to the stop. Oh, it's not nice. It doesn't feel very good. Then price goes like that, and you're feeling confident. So when price is up here, you think, okay, if price comes back to my entry, I'll close it off at break even. But if price goes down here, then you can think, okay, actually, no, I'm going to hold it. It's going to keep going lower. Oh, let me get up at break even. Okay, I'll hold it longer. Oh, let me get out of break even. It's going to go lower. Oh, let me get out of break even. And you can just feel how you can just shift. Your mind shifts from one extreme to the other. I feel extreme confidence. I feel fearful. Extreme confidence, fearful, and nothing can do that to you except a woman if you're a man, or a man if you're a woman, and trading, or your children, where just price goes up and down like that, and you think like, oh no, okay, just let me get out of break even. And you hear that all the time, and actually you can also spot this in the market, and you can also use this to refine your entries, which is a completely different talk. But price came down here, it got here, my entry, and I closed it off, done. And I sat back and I said, wow, that's beautiful. And this was, how long did this take? The exercise took 29 minutes. So it wasn't a long exercise, but it was a very, very enriching exercise, and I loved it. I didn't like this bit, but I like this bit. And I really recommend this kind of an exercise because they are absolutely amazing, and they will enable you to focus on how you feel about different scenarios in trading, and it's a very, very insightful exercise that I encourage everybody to do.
Hey, Sareed.
Yeah.
Well, Saji has a question. He says, how do you balance trade management with these fears, or maybe should I say aggressive trade management?
Yeah, well, ideally, before you get into the trade, you know where you're going to get out of the trade if you're wrong and if you're right. But when you're right, you define where you're going to get out if you're wrong about the trade, so you have a stop. but typically you'll use these same patterns to get out of the trade. So, I mean, for this one here, I wanted to sell here, and I wanted to get out here. Why here? Because this is an area that's been qualified because of the opposing supply consumption. And so I knew exactly where I was going to get in here. I knew exactly where I was going to get out here. So I know that before price gets up there. But when I'm in the trade, then I watch price and I see what it's doing. If price starts to do trendline breaks that go against my trade, then I'm going to remove my risk for this trade. And then I don't want to take the trade off prematurely, but I'm going to get the risk out of the trade. And then depending on what's going on, then you would do something a little bit different. But ideally, you have to be able to decide before you get into the trade, okay, when am I going to acknowledge that I'm wrong? When price gets here, I was wrong about the trade. And you have to know exactly where that is. And okay, how do I know when I was right? How far do I anticipate price to go for me to be right? Then you have your entry, sorry, your target, which is down here. This is wishful thinking. This is wishful thinking. This is realistic thinking. So I don't know what that is. It's like 4 pips, and it's about a 2-to-1 on this trade. So I knew I was going to get out here, and managing this when price did this, I moved my stop to break even, because if price was going to go up here, this would have been the multiple tests on this area of supply, which isn't really supply, it's kind of reaction to this one here, and I didn't want to be in there because I was expecting price to move higher. So I don't know if I completely kind of walked all over the place in answering your question there, Asati. But yeah, I mean, you have to, the best thing to do is to not fiddle too much with it. So you let price move towards your target or your stop, and you don't fiddle too much. Fiddling with it is generally not a good idea. Remove the risk and try not to scale out so much, because it really breaks the your trading model. Okay, James is asking, hi Sareed, is this scalping? Is there a previous archive about this trading? I've been missing the previous course for quite a while, just wondering what would be most important previous archive I should go through to watch, especially scalping. Yeah, we did a presentation about scalping a few weeks ago, James, so maybe that'll helpful. But this is more of this is scalping. This is exactly how you could go about scalping, but I use a scalping trading approach to do these exercises, and I do it on the 1-minute chart because if I want to do an exercise, I want to do it now, and I don't want to have to wait a month for price to get to my entry, because then the whole point of the exercise is kind of dissipated. Okay. And here's another one. Exercise, late entry exercises on micro accounts. And this is to help kind of associate negative emotions with I don't want to miss out on this trade fear. And what you do is you wait for price to move very far, and then you buy it. You buy it when it is, do this on like maybe 1 micro account. There has to be a real account. There has to be emotional involvement in the trade, otherwise it won't really work. And so you wait for price to move down like this, and then you sell it when it gets here. And then you watch it. You have to watch it. You have to, of course, this is very important. You have to watch it like we did this one. Price comes down here, you sell it here, and you watch price go against you, and you identify with a negative emotion that is coming up as you watch price get closer and closer and closer to your stop until you're stopped out, and you'll likely be stopped out. And I hope you're stopped out, because if you're not, then you're probably going to think you can get away with it. And so you want to get stopped out, and you want to kind of be with yourself when you're experiencing the trade go against you until you're getting stopped out. And what this will do is this will prevent you from chasing trades, because you will have experienced, hopefully, quite a few times that if you sell after price has already moved down, you can feel it. It'll become almost an intuitive feeling for you that price will probably come back and you'll lose money, and this is a negative emotion. And then that negative emotion will come up when you see a price structure like this. So your entry was here, price didn't come back, it went down, you clicked in here. If you do that over and over again, you won't want to do it anymore, because your body and your mind and your gut will remember what that felt like, and this will be a warning sign. It's kind of like putting your hand on the hob when it's hot. You do it maybe once or twice, hopefully no more than 2 times, then you know, well, I've seen this hot hob, and if I put my hand on it, it's going to hurt. I've seen this trade, and if I sell it right here, it's going to feel bad emotionally and cost me a little bit of money. So that's definitely a good one. Then I have this last one. This is an egg timer. And this is a good one to help you prevent the fear of losing. So dealing with micromanaging accounts. So what I sometimes do is that if I have an entry on a 4-hour chart, when I enter the trade, I'm not allowed to touch it until 4 hours goes by. So if this is a little bit different on the 1-minute chart because things go all over the place. But if you go to the 4-hour chart, for example, assuming that I bought here, so price went here, I got filled, and then 4 hours, normally about 4 to 8 hours after, I can't touch the trade, and so I have to wait. Rather, I give price some time to mature. And if you have an egg timer and you set it for, let's say, 8 hours, at least 4 hours, preferably 8 hours, then I have to let the market do it, and I have to sit there and I have to watch it. And you think like, oh no, price is going against me, negative emotion, I feel terrible, I want to get out. If price comes back to break even, I'll get out of the trade. This is a whole thing we just walked through. You can't touch it. You have to leave it. You have to let price come close to your stop if that's what's going to do. You have to feel that emotion. The egg time is still ticking. It's only like half an hour. You feel like you're going to die. You have to go to the toilet. You're feeling really dodgy. You can't touch it until the egg timer has gone off. And this, I mean, I'm not recommending that you do this for all your trading, because eventually you'll be able to do the stuff for yourself. But initially, maybe do it so that you give yourself a period of time where you cannot fiddle with the trades. And egg timers are pretty good, I'd say. So this can either be moving your target or moving your stop. So yeah, I did this quite a lot. Yeah. Okay. Yeah. Well, that brings us to the end of the presentation. Let's see if there's